Welcome to the Intelligent Investing Podcast, where modern portfolio theory can suck it. A student of the School of Graham and Doddsville and a clergy member of the Church of Warren Buffett. Here's your host, Eric Schleien.
Hi, this is Eric Schleien. You're listening to the Intelligent Investing Podcast, and today we have on Jeremy Raper, and you're calling in from London, right?
That's right. Hey, Eric, how are you?
I'm pretty good, man. How are you?
Excellent. Thanks for having me.
Yeah, right on. So I'm glad you come on the show. And, I think we were connected on Twitter, and I don't remember whose idea it was to come on the show, but anyway, it's great. It's great to have you on. I like your Twitter account a lot.
Thanks, man. The world is a small place these days, so I expect there'll be more of these kinds of random connections that turn into hopefully interesting podcasts for you going forward.
Totally. It's funny. I've had actually a few guests now where there's been some Twitter connection, and one of us was like, let's just talk about it on the air. This is cool. So,
Awesome.
So just tell the listeners a little bit about like what your background is exactly. I know you're a private investor, but you do have quite an extensive and interesting investment background.
Sure. Yeah. So, as you said, I basically just manage my own money full time. Originally, I grew up in Sydney, Australia, so I had a pretty typical middle class background. Went to high school, graduated high school 2002. So I was 18, and at that point, I kind of left Australia and went to university in the United States. So that was kind of pretty different. Not many people who grew up in Australia actually leave for college and go outside Australia. It's not really the done thing. So it was a bit exceptional, but I wanted to do it. And so I went to study in the US. I studied history and also minored in Japanese. But before I even got to college, I was pretty interested in investing from a young age. So my grandpa was a big investor. He kind of taught me the basics. And when I say the basics, I do mean, very much kind of not Graham and Dodd deep value investing or, even reading Warren Buffett's letters. Very much, this is the stock market. This is what a company is. This is what a share of stock is. Why don't you go and start reading about companies, that kind of thing. So I started doing that very much in high school, but at a very basic, unsophisticated level. And so, the best thing that can happen when you're, I guess getting started into the stock market, obviously you have to have an interest, but, I was lucky, right? So I was growing up during the internet bubble, and one of the two first companies I picked was an small Australian technology company that made chips for not for credit cards, but for when you ride the subway in Hong Kong. They made the chip that went into that, went into like a smart card reading type chip, right?
Like a subway card almost?
Exactly,
yeah, okay.
Exactly. So it was pretty novel in the late 1990s. And this company they won some massive contract in Hong Kong, and they followed that up with a few other wins. And so basically I bought this stock at $2, not knowing what I was doing. And every time it doubled, I cashed out half. And I think I cashed out 4 or 5 times. And of course, it went to zero eventually. But I didn't know what I was doing. But the fact that I was, one of my first decent investments was a big winner, more through luck than skill, that kind of stoked my interest. So when I went to the US, I obviously, had the bug by that point. And even though I majored in history and also did a language as a minor, I continued to try and continue my education as an investor, such that by the time I graduated college, in 2008, I kind of knew I wanted to work in finance. I wanted to be an investor one day, professionally. The problem was it was 2008, right? So, there weren't many jobs to be had on Wall Street. Let's put it that way. But by that time, I spoke Japanese, having developed that skill during my college years.
And what had you pick Japanese? That's interesting.
That was also kind of random, actually. So, because in Australia, when you graduate high school, you graduate at the end of the year, right? So that's when summer is, right? So you graduate in December. And then because I was going to university in the US, I had 9 months or 10 months off essentially, right? Till next fall. So I had to do something. So I could have gone on a trip around the world. I could have done a gap semester in England, which is what a lot of other kids did. But for whatever reason, I'd started studying Japanese very late in high school, and my dad kind of just thought it would be good for me, and I was interested in it. So I went and lived in Japan for 6 months with a host family, kind of like a Japanese language exchange, and learned Japanese. And so that kind of developed into a much deeper love for the language and also the country. And so by the time I graduated college, having built on that education, I used that essentially to parlay my way into finance with a job in Tokyo working for a large bulge bracket firm. Not given my finance experience, such as it was still fairly meager, but because I spoke fluent Japanese, which was relatively rare, I guess, is relatively rare. So basically I became a salesperson selling derivatives of various kinds, credit derivatives, equity derivatives, convertible bonds, from Tokyo to hedge funds around the world, and kind of learning about a bunch of different asset classes, learning about investment banking, learning about sales and trading, and kind of continuing my journey. So I guess, look, that was the first formative years of my career. And I guess it was really, really important for how I developed as an investor, because like we'll talk more about my investment style, but essentially everything that I do today and the way I view risk and the way I try and generate excess returns is grounded in those first 4 to 5 years I spent in Japan. Because during that period of time, I noticed there's maybe 2 key lessons that kind of guided the rest of my career. And I think they're relevant probably to your listeners as well today, given the rest of the world increasingly looks more and more like Japan from a monetary perspective, right? So the first thing is, by 2008, which is when I began my career, people think QE, so zero interest rate policy or, quantitative easing or whatever you want to call it. People think that's a novel phenomenon, right? That it only happened in the US post the crisis, that it only happened in Europe in the last, 6 or 7 years. But what they don't realize is that QE is actually a Japanese invention, really. Right. So the Bank of Japan cut rates to zero in 1992, or essentially zero, and has never looked back. So if you want to understand what chronically low cost of capital does to a capital market, you go to Japan, because that's ground zero. And so the first thing I noticed when I was there was there is no culture of credit analysis. So I guess that begs the question, what is credit analysis? But essentially what it means is, instead of thinking like an equity investor, right? So if I spend $1 buying a share, the most I can lose is my $1, but if the company grows, whatever, it could go up 10, 20, 50, 100 times, right?
Right.
So that's the typical equity mindset, right? You have an open-ended call option on the company's growth, and therefore you're much more interested in growth than anything else. You care about blue sky, you care about the TAM, you're an optimist, right? That's kind of natural if you own stock. A creditor is completely different. The most the creditor can get back is his loan. If he lends money to a company, his upside is getting his money back. Maybe he gets a coupon along the way, maybe not. So his perspective, prima facie, is, I don't want to say negative, but it's skeptical, it's cynical, it's what's my security, where am I in line, what are the assets backing my claim, how much cash are you generating today, not how much cash might you generate in 5 years. Actually creditors don't care about growth, because growth often consumes capital, most often actually, unless it's some great service business or it's Amazon.com. Growth generally requires capital investment, whether that be in working capital or whatever. So what I mean when I say there's no credit mindset, what I mean is that skepticism, that thinking about my downside much more than my upside. And also the pure language of a credit analyst, right? So thinking about, debt service coverage ratios, thinking about fixed charge coverage, thinking about debt to assets in a conservative credit first way had completely disappeared from the market. I guess if you think about it, it's natural, right? So after 30 years of zero rates, the spread in credit cost terms, right? The spread charged to lend to a very good company, let's call it Toyota, right? So one of the best credits in the market was Toyota, the large car company.
Sure.
They could borrow at essentially zero, right? 5 basis points over JGBs, and JGBs was zero, right? So essentially 5 basis points. Now, the spread to charge to the worst company in the market, which for many years was a company called Sharp, right? They make TVs and, microwaves and white goods. But essentially the consumer electronics company Sharp has been pretty distressed for the better part of a decade, right? Now, at the time, the spread being charged, on Sharp credit was 30, 35 basis points, right? So imagine, putting it in a US context, right? If I said that, what's a AAA rated US corporation? Let's say, I don't know, Google's very high credit, right? If I lend to Google at 5 basis
Coke,
points, but I lend
Johnson
to
& Johnson, right? Any of those?
Yeah, Johnson & Johnson at 5 basis points, but then I lend to PG&E, right? The bankrupt utility, let's call it.
Yep.
If I lend to them at 30 basis points, that's not much of a spectrum, is it?
That'd be ridiculous.
Exactly. So that makes sense that this kind of credit sense of thinking, this credit-based analytical framework would disappear because the market is simply not paying attention. The market is not paying you to do that work. But the problem with that mindset that I realized is that every now and then it does matter, because it doesn't matter that the banks are willing to lend at an irrational cost of debt for a couple of years, because a lot of these busted companies, they're still competing in globalized commodity markets, right? So, going back to the Sharp example, banks are lending to them at 30, 40 basis points for 2 or 3 years, but they're still burning cash. They're still almost negative EBITDA. They're still competing against Chinese money that set up new factories in China and has basically destroyed their display business, right, and their television business through lower cost commoditized production that Japanese labor and Japanese fabs just can't compete with, right? So the business cycle goes on, in other words. There's still winners, there's still losers. Doesn't matter if you get free capital, you just end up becoming a zombie. And so the point is really, one, you still need to do the work because at some point the banks will still turn off the tap. That was lesson one. And then lesson number two is a very important corollary, and it directly relates to kind of how I deploy risk today. And that is, just because you think like a creditor doesn't mean you then apply those lessons in bonds, right? Doesn't mean you only play in fixed income. In fact, in markets where you have structural QE or structural low interest rates, you actually want to apply the fruits of the credit analysis in equities, right? Because invariably when the banks do tap these kinds of companies on the shoulder and force them to recapitalize, there's so much excess liquidity in the system that it doesn't happen through bankruptcy, right? So bankruptcy is just a court-led process to recapitalize a company, turning debt into equity, right?
Right.
So what happens instead of having a court-led process is invariably the banks say to the company, you need to delever. Those companies turn around and issue a boatload of shares, diluting existing holders to the benefit of creditors. So you get the same recapitalization, debt for equity. It just happens in the equity market.
Okay.
So, during that time, I was in Japan from 2008 to 2012, as a salesperson, right? So I wasn't deploying risk, but almost, this was not a sector-specific phenomenon, right? You saw this pattern happen over and over and over again, whether it be in the airline space, automotive, consumer electronics, integrated electronics, industrials. It was almost a market-wide phenomenon that would develop over and over, mostly on the short side, but not exclusively. You did have a few bites of the cherry on the long side, where these troubled companies would just get into a debt hole. It would spin for a couple of years. They'd end up violating a few covenants that no one were really looking at because no one really looked at, covenants properly. The banks would force them to delever. They would issue a huge ton of shares. The stocks would get destroyed, but the credit would be okay. So you didn't want to bet against the credit, you wanted to bet against the stocks. So that was kind of my formal education starting point and where I developed my investment philosophy, which is, what I call credit-based equity investing, or thinking like a creditor but applying it to stocks. Because I saw, from my Japanese experience, one, this kind of work is not being done in this market. And two, because of the nature of the monetary policy, I guess in Japan at that time, but developing in other markets post the crisis, I thought it would be quite likely that other credit markets and equity markets would devolve to this kind of situation where, credit markets are essentially not sending the right signal. The cost of credit is not being priced accurately. When we can talk about a few examples, or when we get to one of the examples that I actually like on the short side now, it's kind of a perfect example of this, right? Okay. It's a German company, mid-cap, well-covered, terribly levered, terrible business, where the bonds trade at, 1.5%, just because the ECB is buying up every bond that's investment grade rated, and these bonds are double B minus, but they're the only thing left to buy with any yield on them, right? So that's kind of, in a nutshell, my education as an investor. I didn't give you the most recent years of my career, but essentially I went from the sell side to the buy side in various roles, and then just started investing full time, and may look to do something formally in the future in terms of a fund. But for now, I'm just a full-time investor using this methodology.
Interesting. When you were in Japan, what did real estate look like in Japan back then, or even now?
So real estate's gone straight up with QE, essentially.
That's what I would think, right? Especially with interest rates so low, it's just like, why not borrow for 30 years and, make the spread, right?
A lot of people have done that. A lot of people have and continue to do that. I've never been a huge real estate investor, either directly or indirectly through REITs or through real estate developers, just because I've always been attracted to the liquidity profile of investing in the stock market, right? So if I get something wrong, I can turn around, get my money out immediately, right? Essentially. And look, a lot of these real estate
because there are
trades,
there are a lot of Japanese companies. I think you can tell me if I'm wrong, but I think I've seen quite a few where you'd have just a ton of real estate on a balance sheet of a stock.
Yeah. So look, the original kind of impetus for that phenomenon was the 80s bubble, right? So Japan had the world's biggest stock market bubble in the 80s. Everyone's probably heard the old anecdote that the land under the Imperial Palace in 1989 was worth more than the entire state of California, right? So no one has ever seen a real estate bubble like the Japanese stock and real estate bubble of the late 1980s, but that was essentially the beginnings of what you're describing, right? So a lot of companies owned some land. That land took off in value. They'd borrow against the increased value of the land. They'd use that borrowed money to buy more land. They'd pyramid on up and up and up. And obviously that would provide fuel for the market. This happened for a decade, then it all blew up in 1990, essentially. And so then in Japan, they spent the next, 10, 15, at least the next 10 years trying to repair the financial system because all the real estate collapsed, which meant all the banks collapsed. They merged, from 8 or 9 big banks to 3 or 4 big banks. Half the regional banks went bust. A lot of the securities companies went bust. And then there were a few companies, some of the better credits still had land on the books that got marked down a lot, but, then they kept it. And then it started going up again from 2010, let's say. Once QE really kicked off.
Why do these companies keep land that they're not really using? It seems like a very Japanese thing.
That's the $64,000 question. Why do any of these Japanese companies own half the things they own that they they don't really need? So is there a cultural thing there that? There's definitely an element where the Japanese public company is a bit like an empire, right? So there's an old saw about Japanese companies that every second Japanese company owns a golf course, right? So probably because the chairman likes to play golf, right?
Okay.
But I mean, culturally, Japan is an interesting place because we think of it like a capitalist democracy. It's definitely a democracy, but they're not really that capitalist, right? So they talk about stakeholders, and when they talk about stakeholders, they mean first and foremost employees of the company. Then they mean society at large. Then they mean maybe shareholders, number 3, and a distant number 3. The vast majority of Japanese companies don't exist to serve shareholders in the way we're used to in the West. They basically are there to support the corporate unit, which is viewed as a second family. And the reason for that is lifetime employment was a big part of the post-war appeal to Japanese, right? You will work really hard for probably meager wages, but you'll be treated like a family member at this company. You'll never be fired. You'll have a real emotional stake in the well-being of the company. That kind of promise was never made to investors, right? So I mean, look, that's a huge cultural holdover. It's changing slowly, but a lot of the strange behaviors you see from Japanese companies, right? So there's this Japanese company, for example, right, called DIC Corp.
Okay.
They make printing ink. By the way, I have no position in this company. They make printing inks. They have a couple other businesses. It's not a small company. It's a few billion market cap. But they also have one of the largest collections of modern art in the world. That the value of their modern art collection is probably worth 3 times the market cap.
That's so
but
bizarre.
They don't even disclose what they own, really. It's basically a private museum in a random part of Tokyo because the founder of this company was really interested in art. And he built up his collection starting in the 60s and 70s. There's Basquiat's in it. There's Koons, there's a Jeff Koons pieces in it. I mean, there's multiple hundred pieces of work. If you even tried to market the stock would and put out some kind of assessment of it in an equity research report, the stock probably go up, might double or something.
But there'll never be any activism there, right?
Exactly. That's the thing. So, it's not a matter of, and we can talk about this, I guess, when I come to my investment philosophy, but it's not just a matter of finding cheap stuff, right? Japan is the land of cheap stocks.
Right.
The last bastion of nets is Japan. It's not good enough to be cheap. You also have to be able to get the value out. And that's why I think thinking like a creditor is actually really valuable, because as most good creditors will know, part of the security is getting repaid. So part of the security of having a credit claim is getting that carry, right? Getting that 10% coupon or getting that cash flow sweep. In other words, for distressed companies, creditors will often only provide credit when they get a piece of the excess cash flow generated by the business. So if you think in those terms, doesn't matter how cheap it is, if it's just accumulating on the balance sheet and you have no way to access that cheapness. You always have to find a way to try to catalyze the cheapness and get it into your pocket.
Do you look at United States stocks as well?
Oh, yeah, absolutely. Okay. Absolutely. So, I look at developed market securities worldwide. Essentially, I focus on three main markets: Japan, North America, so US and Canada,
sure.
And then Western Europe. Don't really do much in Australia. Don't really do much in Hong Kong.
Any reason for that, or
Australia? Okay, so Australia is an infuriating stock market. It's the world's most expensive stock market if you look at anything of quality and anything of size. And the reason for that is there's just too much money there, right? The superannuation scheme is one of the world's largest relative to per capita, because they started it very early, and they force a very high percentage of your annual wage has to go into superannuation. It's like 12-13%, something like that, and they started it in the 50s or the 60s. So there's a huge amount of money that essentially is capped.
Superannuation. What does that mean?
Oh, sorry. So like a 401k equivalent.
Okay, got it.
401k equivalent started very early relative to other countries and was mandatory and is mandatory. So there's a huge amount of capital that is almost all going into the Aussie stock market. So anything that's in the main benchmark index, anything that's, has any kind of profile and liquidity tends to be very expensive on a global scale. At the other end of the spectrum, there's a ton of bombed out mining stocks that are actually really, really cheap. But then you have liquidity issues, right? So Australia's a bit of a look. I've invested in Australia before. It's fine. It's just for my particular style, I found it a little bit more tricky place to invest, as opposed to Japan, where even at the very, very small end of the scale, liquidity is not a problem, right?
Right.
So one of my key long ideas this year has been a company called Shinoken.
Okay.
The ticker is 8909. It's a real estate developer in Japan. And when I started investing, the market cap was, $250 million, but it still traded $5-6 million a day, right? Now the market cap's up to, call it $450 million. So it's gone up quite a bit, and it's trading, $7, $8, $9 million a day, right? So if I took a $250 million company in Australia, it might trade $100,000 a day, right?
Wow.
It's just much more difficult. Yeah.
Interesting. So with a personal account, you could potentially make a lot of money in Australia.
Yeah, look, there's opportunities everywhere, right? I guess it's just, I'm not winging around hundreds of millions of dollars here. So clearly, if there's something interesting in Australia, I'll definitely look at it. But Japan is the most liquid market outside the US by far.
What is your process for finding either, say, super tiny Australian companies or companies in Japan?
Sure. So look, there's three key ways I generate ideas. The first and by far the most important is what I call cumulative, right? So new ideas grow out of old ideas. New ideas grow out of past learnings, past things I've looked at. So that could either be, a different company in the same sector. So I looked at Japan Airlines, and then I started looking at ANA, another airline, right? Or it could be, a different geography but the same sector. So I looked at JFE Steel or Nippon Steel, two big Japanese steel companies. Then I started looking at ArcelorMittal, Europe's largest steel company, or actually the largest steel company in the world. Or I started looking at US Steel or AK Steel, right? So, if it's a global commodity business, as steel obviously is, looking at a Japanese or European or US steel company, they're all much of a muchness. Similarly, if I've looked at an airline, then when I start looking at, aircraft leasing, it's an adjacent sector, so I already have some kind of bedrock of knowledge I can build upon. So at any given time, I'd say ideas in my book are probably 70 or 80% cumulative based. It's based on past learnings and areas where I've had success or failure, but at least past learnings. Then the second bucket of ideas or ways to generate is through what I call idiosyncratic. So this is essentially everything that doesn't fit into a neat systematic kind of idea generation schematic, right? So, I'm a member of Value Investors Club. I've met a lot of really smart people on that site. Obviously, I met you through Twitter. That's another great resource. I try to read newspapers, essentially, 3 or 4 daily newspapers around the world, not just, finance news, but general topical newspapers as well. I try to read blogs, investment blogs. I try to read industry newsletters like shipping newsletters or mining newsletters, these kind of things. Anything that kind of is interesting and maybe peripherally related to what I'm looking at. And look, this is very much kind of turning over tons of rocks and then maybe picking up 1 out of 10, 1 out of 15 for further work, right? So kind of an inch deep but a mile wide type approach to try and cover a fair amount of ground. That's the idiosyncratic approach, everything that's not systematic. And then the third bucket is clearly systematic. So this is essentially, proprietary screening where I will screen my 3 main markets, Japan, North America, Western Europe, for A, size, in other words, removing the ones that I think are liquidity constrained. Then I'll remove the sectors that I don't think I have any business investing in. So as you probably gathered from my kind of credit-based approach, it's very much a balance sheet-driven approach, right? It's very much a tangible asset and liability-driven approach. So if the business is like luxury goods, for example, if it's Montclair or LVMH, the real value of the business is in no way reflected by the tangible numbers on the balance sheet, right? Because the intangible component of the business's value is so high. So I could never really invest one way or another in branded, highly branded goods, luxury goods, let's say. For a similar reason, I could never really invest in biotech or pharma, right? Unless you're a doctor or a specialist, you're never going to see on the balance sheet, the value of this drug is $10 billion, right? But it could be. So no pharma, no biotech, no healthcare, probably very little software, maybe some highly commodity software, but generally no software, and no luxury goods. So basically everything else is very balance sheet driven approach works, industrials, cap goods, resources, commodities, consumer cyclicals, obviously, and then consumer discretionary, as long as it's not too heavily branded. Those sectors are kind of my happy hunting ground. So I put those through the blender, and then after all that, I screen for some very specific, I want to say cash flow based metrics, but they're more like customized cash flow based metrics, right? So one of the things I try to do is I really try to look at what sustainable free cash flow is. So a lot of people talk about free cash flow as being, the foundation of a business's value, and I subscribe to that. But the problem is, you have to really tinker with free cash flow, right? Because if you look at free cash flow in, year 5 of the investment cycle for a mine, it might look really bad, but in year 6, it might look really good.
You're basically
right?
normalizing free cash flow.
Yeah, normalizing. Yeah, I guess normalizing is one way to put it. I guess I think maybe it's slightly more sophisticated what I try to do. So, for example, instead of just normalizing for, say, growth versus maintenance capex, right, which is a pretty standard normalization,
right?
I'll also try to normalize for where I think we are in the cycle, right? Okay. So there'll be some price normalization. If it's a commodity business, I'll make some normalization assumptions, not just on the capex line, but also on like the ASP line, let's say. Mm-hmm. Then I do a few other things that I think are a little bit different. So one of the things I do is I consider working capital a structural cash drag or a structural cash addition. What I mean by that is, going back to my first point, if this is a business trying to grow, then it's going to consume cash. So I don't want to give them the benefit of that growth. I want to be punitive, right? So if they're trying to grow, I will subtract the capital required to grow from my calculation of sustainable free cash flow. And the reason I'll do that is I'll assume that they're in growth mode, therefore they won't be giving that cash back to shareholders anytime soon. And that's just not my cup of tea, right? That's not what I kind of look for. So I'll deduct, say, structural working capital drag, or I will add back structural working capital addition. If it's a service business where they pay their suppliers in 90 days but collect from consumers, immediately, and or they don't have to carry inventories, I'll give them the benefit of that on the other side as well. And then the third thing I do to adjust for my definition of sustainable free cash is I consider a structural advantage the difference between cash tax and statutory tax. So this, I think, is quite important in some industries in particular, right? So if you look at, say, aircraft leasing, which is probably my favorite space on a long-term basis, right? So one of the benefits of, say, aircraft leasing that people don't really appreciate is, let's take a company like Air Lease, right? So it's, 5 billion market cap, trades at 10 times GAAP earnings, or maybe slightly less than that. It's growing pretty rapidly. They've never really lost money. They have a great management team, basically run by the guy who invented the entire sector. And they report under US GAAP, right? So they're reporting at a US GAAP stat tax rate of, around 25%, let's say. But none of the planes are actually domiciled in the US, right? All the planes are domiciled in Ireland or whatever. So what they're doing is actually GAAP EPS, not statistically, but actually overstates the amount of cash tax structurally. Because as long as the planes are domiciled outside the US and as long as the tax laws don't change, again, those are assumptions, but for our working purposes, let's leave them as is, then, you're getting the difference between stat tax rate and actual tax rate as a deferred tax liability that just builds up on the balance sheet as a liability every year over and over and over. So what do you call something that is a long-term liability? That's actually free financing, basically, right? So the actual earnings power of the underlying business is chronically understated by the GAAP P&L, and you need to adjust for that. So I'll make all those three adjustments. I'll adjust for growth versus maintenance CapEx. I'll adjust for where we are in the cycle. I'll adjust for structural working capital drag or addition. And then I'll also adjust for what I think is a sustainable stat tax versus cash tax differential to try and get some kind of sustainable free cash flow number. And then I'll screen for that and a few other metrics around there. And then the goal is obviously on the long side to pay a very low multiple of that number. So I'll never buy something over 10 times that number. Just a hard and fast rule I have. And then on the short side, obviously, if that number is sustainably negative or, a very, very high multiple of that number, plus a busted balance sheet, plus a credit catalyst, which we can talk about, then it could be a very interesting short.
And what are you using to screen?
So look, Bloomberg is a pretty useful tool, right? So EQS is the function you can do an equity screen on. Okay. So essentially, you can set that screen up pretty quickly and just run that, say, once every couple of weeks. It doesn't have to be on a daily basis, right? Things don't tend to move that much. So I use EQS as my go-to. Got
it. Cool. Also, speaking of airline leasing companies, have you ever heard of AerCap?
AerCap is my largest long.
Oh, it
I
is?
love AerCap.
Okay.
Yeah. I've been a long time bull on AerCap. It's a very high quality company. They haven't lost money. As a public company, they've never lost money. They didn't lose money in 08, 09. The stock got obliterated because of financing conditions, obviously. But that's the interesting thing about AerCap, right? It trades as if it is, I don't want to say as if it's an airline, but it trades with the stink of an airline.
It trades like it's distressed, yeah.
Exactly. When in actual fact, I guess the right way to think about it is most people will comp it to other asset utilization businesses, right? So other leasing businesses like equipment leasing or whatever, or ship leasing.
Sure.
But the thing they don't understand is that airlines is essentially an oligopoly. It's a two-player market for fixed-wing passenger aircraft. There is only two players. So supply and demand for fixed-wing passenger aircraft has been far better managed than any of these other equipment leasing businesses or ship leasing businesses for a generation, because it's in the OEM's best interest, right? It's not in Boeing or Airbus's interest to flood the world with planes and watch the value of those planes decline, because they have a 10-year black backlog they're trying to sell at increasing rates, that at least keep up with inflation. So that provides the people who then buy that equipment at an initial discount, which obviously AerCap does, and then lease it out on long-term fixed contracts. That provides them with a huge amount of security because in a sense they're on the same side as the OEMs, right? Whereas they're not really on the same side. If you buy ships, right, from a shipyard, and then you lease those out, and the shipping rates go way up, you're not on the same side as the shipyard. The shipyard wants to pump out more ships. So it's actually quite a unique kind of financing business, and one that, look, it hasn't really gotten credit for a very long time, but I don't think you need that to make money even from here. It's had a pretty decent year, but these names are dropping like flies, right? The private market is picking up businesses, these kinds of businesses left, right, and center. And so, look, I fully expect AerCap to be taken out at some point by a large financial institution with a structurally low cost of capital, much like Aircastle got taken out by a Japanese bank and trading house consortium. It would not surprise me to see AerCap taken out in 3 or 4 years by some Japanese insurance company or Japanese bank consortium. Having once Angus, the CEO, Angus Kelly, once he's achieved his midterm growth targets, when he's happy to sell the business, I'm pretty sure he gets it, and that's probably where the business is going to go.
How do you compare AerCap to the other business you just brought up before?
You mean how do I look at it as a long on my metrics?
Yeah, because you said a lot of nice things about that other company. I forget what the name was now.
Was it Shinoken or was it Air Lease?
Yeah,
Air Lease is
the
other one. Yeah. So I use Air Lease because that's a pretty clean example to demonstrate the cash tax versus stat tax anomaly, because they are US listed, US GAAP reporter, but obviously the planes are domiciled offshore. Actually, AerCap's reported tax rates are much closer to their actual cash tax because they are Netherlands domiciled and Ireland based. So there isn't as much of a discrepancy there that I need to adjust for. Look, those two companies are not too dissimilar. They both kind of have their roots in the beginnings of the aircraft leasing business. The main difference is AerCap is completely agnostic to growth. So going back to what I said, I really don't care about growth. In fact, I prioritize no growth if I'm getting the capital back. So that's exactly
because they
how
buy
the CEO,
back a lot of stock, Angus.
Yeah, exactly.
Yeah.
So they've made it extremely clear over and over and over again they do not care to grow the fleet. In fact, the fleet in absolute terms has not grown in 3.5 years.
Didn't they buy back it was like 30-40% of their shares outstanding a few years ago?
Yeah, in the last 5 years, they've retired 39% of shares at the time through buybacks, which puts them in the top.
I'll tell you, I've
2%
listened to a lot of their conference calls. The CEO is a really, really sharp guy.
Yeah, Angus is true outsider CEO. If he left, it would be devastating. A brilliant CEO, and they've been very clear about their capital allocation priorities. So they can sell a 10, 11-year-old fixed wing plane at 8% above their carrying value for the plane, but obviously they finance it, right? So
and then they buy back below book value, right?
Yeah, exactly. So there's a huge arb, right? So as long as that exists, they'll continue to do it, even if it means they don't grow. They're happy to sell their planes down. And look, they sell, call it 1 to 2 billion net book value of planes every year. They have a 35 billion asset fleet. So call it 5 to 7% of the book turns over every year. And with that 5 to 7%, they retire, 8-9% of the stock, essentially is the way to do it. So every year owning 8% more of the company, maybe 9% depending on the year. And actually also at the same time, the balance sheet is getting improved because they've repositioned the fleet from being quite an old fleet, which it was when they acquired ILFC's business in 2014, to a much younger business with a much better credit profile. In other words, they've locked in the leases from their customers for 7.2 years on average, whereas 5 years ago it was, I think it was under 5 years. It was a much shorter period of time.
Right. Interesting. Interesting. So what are your I know you said you short as well, right?
Yeah, shorting is very much bread and butter to me. I can't recommend it to everyone because it's a very different risk profile, clearly. But I'm not one of those guys who wakes up in the morning and thinks the stock market is going to go up every day. In fact, the fact that it has gone up every day for, I don't know, at least the last year or a couple of years, and we've had a bull market for 11 years, it caused me a lot of angst. Because I'm the kind of guy who worries that one day the whole market is going to open down 30% just for whatever reason, right? QE ends, or God forbid there's some other kind of terrorist attack. I don't hope it doesn't happen, but I just can't go to bed at night being 70, 80, 90% long, or even 50% long. I really would not be able to sleep. It's not my personality.
I hear you. What do you think though? Just from your experience in Japan, and now we have low interest rates in the United States, Do you see a lot of parallels? I mean, are there things you learned in Japan that you applied to looking at U.S. markets?
Yeah, I mean, absolutely. Look, there's many differences, but there's also many similarities, right? So essentially what's happened in Japan over the last look, the reason interest rates are zero in Japan now is because they haven't been able to grow their way out of stagnation, right? So demand there was so much excess demand pulled forward by the bubble that there's just a huge amount of slack in the system, and no amount of stimulus has been able to shake the economy, in a fundamental way. There have been periods of, 18 to 24-month periods of growth, but in a very fundamental way, there's been no escape velocity for that economy, right? And part of that's demographic, let's be honest. So look, if I was to comp Japan to the US, right, I would say on the monetary side, it's looking increasingly like Japan. However, on the demographic side, it's completely different. So I don't want to push the comparison too far,
right.
But because of the extent of low interest rates and how they've devolved globally, honestly, actually, I think Europe is in a much, much worse position than the US, and it's a much better comp to Japan. So Europe is definitely worth making that direct comp. But anyway, going back to the US, I don't want to stretch the comparison too far, but from a monetary perspective, a lot of those Japanese mistakes have been made and are being made in the US, just because we've had easy money for so long. And there is this assumption in the market, particularly since Trump's come in and more recently, there is this kind of, buy the dip no matter what kind of mentality that the US president, the US leaders have kind of encouraged. And I guess Powell has obviously encouraged by backflipping at the end of last year on the plan to tighten, right, and kind of completely capitulating. So there is this mentality, I think, pervading the market that, stocks will just not be allowed to go down, which the last time that happened was 2007. So, and by the way, I'm not massively bearish and I'm not, net 50% short or anything like that. But right. It's the reason why I run my book, say, 20% net long and beta adjusted close-ish to flat, because there will be a reckoning, right? As it's as clear as mud. Trees don't grow to the sky, and you have stock market corrections. That's been the case since stock markets were invented. Just because we've had 11 years of bull market doesn't mean it won't happen again. It just means all the people operating in markets these days weren't around the last time the market fell out a bit, or a lot of them.
Could you see a situation where we just go into this like low growth stagnation for another 10, 20 years with low interest rates?
I could. Maybe demographics pales the US out. I could definitely see it. And if that's the case, why the hell would you want to own stocks here, right? Because the Japanese analog then becomes much more relevant. If you look at Japanese stocks, look, not only have they done nothing in absolute terms since 1990, right? They're basically flat.
Yep.
But the valuations are just a fraction of where we are in the US, right? Yeah, the Topix trades at what? Around book, or a slight premium to book value, versus the US at what? 2.5 times book, the S&P, that is. And just in terms of average multiple, right? The S&P is at 18, 19 times earnings, and the Topix is at what? Low double digits, right? So, all these guys in the US who say, oh, we're just going to have low interest rates forever, therefore the weighted average cost of capital, cost of equity has to come down as the cost of debt structurally low. Well, no, cost of debt's been zero in Japan for 25 years, and those stocks are still cheap. So,
all right,
which one? That isn't that an erroneous conclusion? So,
because Buffett, right? I mean, he has said if interest rates stay low for a while, then we'll look back and think stocks were really cheap today.
Look, I'm not one to tell Warren he's wrong, but
no, please.
I think that I think that maybe he has a more sophisticated way of coming to that conclusion. But to my mind, that's essentially saying the credit market is sending the right signal, right? I think we have to understand why interest rates are so low. Interest rates are so low because they're being artificially suppressed by central banks. They're not so low because, and obviously because growth is very low and a fundamental ability to grow is low.
Do you see the artificial suppression though stopping? Like what if they do it for 20 years?
Well, look, I guess there's two. You asked two questions. Do I see it stopping? Sure. I guess yes, okay. because you're going to have political, fiscal policy is going to change, right? Because rates have been so low for so long, and you've had this extended narrative of the wealthy getting wealthier and the haves getting more to have and the have-nots just getting more mired in the mud. It's leading to political change. Political change is highly likely to be inflationary, highly likely, no matter what happens. And inflationary conditions will change interest rates, right? Eventually. And when that happens, well, I throw everything else out the window. We're much more likely to have stagflation than stagnation, I actually think. So, look, I own a little bit of gold.
Yep.
It's not my base case scenario, but I don't think we're going to muddle along in this kind of stagnation forever with stocks levitating forever environment. And I guess the other part of the equation. Sorry, I've just to finish that thought. The other part of the equation is corporate profits, right? So it's not just the discount rate; it's the absolute level of corporate profits are at all-time highs. Essentially, margins are at all-time highs, and the reason for that is corporations have way more power than ever before, right? So Jonathan Tepper's thesis, right, that the myth of capitalism, that you have far more concentration and oligopolism than people think, and that leading to corporations making more money and the little man getting screwed, the worker getting screwed. That plays into this as well. So I think we're much more likely to see a scenario where, globalization kind of has not run its course, but becomes more difficult, right? Trade wars, tariffs, etc. So things get more expensive. Wages have to go up to placate the people who've lost out the last 15 years. Then you also have this political imperative coming, which would be highly likely to be inflationary, running budget deficits, what have you. Add that all in a blender, it's very hard to see how rates stay this low forever.
Right.
Very hard.
Right. Interesting. So do you look a lot at longs that will play into an inflationary thesis? Not really. Okay. Not really. I guess I try to pay attention to the broader market environment, but I try to find stuff that, look, if I'm right on some of the broader views, like let's say I'm right on this inflation view, which honestly I'm not wedded to. I haven't tried and nailed it down to the nth degree. But if I'm right, I can make a lot of money. But even if the status quo continues, I won't get hurt too badly, right? Or I'll make a little bit of money. In other words, again, think like a creditor, downside before the upside. If I take care of the downside, the upside will take care of itself. So look, I'll tell you, I own this gold company called Polyus Gold. Okay. PLZL. It's listed in London. It's 10, 11 billion market cap. It's a Russian gold miner. So look, this is not everyone's gold company, but it's extremely cheap, right? On gold prices today, it trades at about 7 times free cash flow. They are the cheapest large cap gold company in the world by a country mile. They have the best assets in the world by a country mile. They have excellent growth prospects where they could basically they could add 50% to the annual production profile of their business within 5 or 6 years if one of their growth projects comes to fruition. That's all with gold at $1,450, right? Okay. Now, if gold gets a bid and gold goes to 2,000-3,000 or wherever it could go, if inflation really explodes, guess what? This thing will be an absolute home run. But if it doesn't, I'm getting paid a 7% div. Trades at 7 times sustainable free cash. It's got very solid growth prospects. I could make a very solid mid double-digit IRR on this investment, even if gold doesn't go to the moon, even if gold flatlines, right? That's how I think about it. So, yeah, it's great to have some upside optionality if it comes through. But if it doesn't, I want to be getting paid a kind of 10 to 15% return, whether that be through, divs, buybacks, and or, cash generation, free cash flow generation to the balance sheet. So what would you say right now is your most interesting long idea? Okay, so on the long side, it's that Shinoken name that I mentioned, this Japanese. But it's a Japanese small cap. So and all the disclosures, well, not all of them, but basically all the meaningful disclosures are in Japanese. So I'm happy to go through it. But what I would probably encourage is if anyone's interested, they can read up. I did a write-up on my blog, which kind of goes through the case in some detail. And they can maybe take a look at that. But look, essentially the story, I'll give you the story in a nutshell. Cut me off if it's if it's too long. But they develop apartments, a very special type of apartment, right? And that's half the business is developing apartments, right? It's a pretty typical boom bust kind of cycle. Development profits come, development profits go. Now, 3 or 4 years ago, that was like 80% of the business. Now it's only half the business. The reason it's only half the business is because they don't just develop and build apartments, they also manage apartments. And as they've grown, the management portion of their business has grown massively, right? So every year they're adding 5,000-10,000 units.
They manage them. They provide rent insurance. They rent guarantee, that is, to the tenants. They basically guarantee for a large portion of their managed buildings that occupants will pay rent. And they get a fee for that. Then they also provide electricity and gas to the apartments. They get a commission on that. Then they also provide outsourced life care services. In other words, when people age out of these apartments and want to move into a nursing home, this is big business in Japan, by the way, given the demographics, then they'll provide you, they own a few nursing homes. They also have connections with other nursing homes. They'll provide a fee. They'll get a fee rather for placing those residents in homes. Then they also bought, a few years ago, they bought a general contractor. So essentially just a building company that builds not just their own apartments, but builds a wide variety of other people's apartments and also non-apartment work as well. So only 20% of that business comes from Shinoken internally, so 80% is external business. In other words, the stock market looked at this business a year ago when the real estate market, when this particular subset of the market they focus on, I won't go into it on the call, it's very complicated, but essentially, they focus on a very small niche. When this subsection of the market came under a lot of pressure because of stuff going on unrelated to Shinoken, but to other companies that were kind of behaving badly. The stock market looked at this a year ago, and they only looked at the real estate development business and thought it was a boom-bust business, potentially going to the wall or getting close to being distressed because of external circumstances. When in reality, half the business is recurring revenue, much more like a REIT type management type revenue stream, which is deserving of a much higher multiple. So that happened last year, carried over into this year. I initiated a position earlier this year around 750, 800, at which point I thought it was trading, under 4 times earnings with pretty modest leverage by historical standards. 4 times cash earnings. They were buying back a little bit of stock, highly incented management. Management owns 35% of the business. And I was also making a bit of a call on the market recovering, right, for various reasons, which I go into on my blog. Fast forward to today, they put up 2 solid quarters. The market appears to have stabilized in the development segment. The management segment is still going gangbusters. Margins are increasing with scale. And now, as I said, management revenues, or let's call it non-development revenues, are half the EBIT. So it's starting to look more and more like a high-quality business, even though it is still a small cap, right? So the stock has re-rated from 4 times earnings to 7 times earnings. But obviously, I still think there's a lot of low-hanging fruit. There's a lot of meat on the bone still, given listed REITs in Japan trade above 15 times earnings, right? So to the extent they can gravitate towards that multiple over time, and I think also the development segment will start to recover from next year. It's not a stretch to see this business trading at a low teens multiple.
Interesting.
Which would imply, almost another double from here, right?
Right. What about your second most interesting idea? And then I'll do a short idea.
Oh, so you want to do the short, so you want a second most interesting long?
Second most interesting long, and then give me a short after.
Okay, so look, we already talked a lot about AirCap. Yep. I'm not sure it really covers the basis as an interesting long. Let's see. Let me pull up my book here and take.
Are you buying more AirCap today?
I sold some puts after they did the placement of the Waha stake. So the stock went up to 62, 63. Then the Emiratis, who were essentially the big overhang on the stock for most of the last couple of years, because they went from being 14% of the company to 6%, they sold the final 6%. And of that 6%, 2% went back to the company and 4% went into the market. So, it's a decent amount of shares that went out. Stock was down 5%. So I sold some puts. I already have a very large position. Okay. So my second interesting long is I don't think it's as speculative as it's probably about as speculative as Shinoken for different reasons. So caveat emptor, as they say, but I think it's a very interesting setup. It's called GAN, GAN.
Okay.
It's listed in London. Okay. They're a B2B provider of software for internet gambling, rather. So essentially, they do the back end software for a bunch of 1 or 2 European casinos and then a bunch of US-based casinos. That's not really the key story, though. The key story is they're plugged in with FanDuel. FanDuel, the fantasy sports betting.
Yeah, they advertise a lot.
Yeah, exactly. So FanDuel is growing like a weed, fantasy sports, but actually they've expanded very aggressively into sports betting. So sports betting is like the next gold rush for for growth, let's say. And I should mention, this is not my typical kind of, credit-based idea, because this is a little bit light on cash flow now, but it's just so cheap and growing so fast with a clear catalyst. So I think it's interesting for your readers to look at, or your listeners to look at rather. So let's just look at it real quick. So it's about £110 million market cap, no debt, slightly net cash actually. So let's call it 105 million enterprise value. It's listed in London. It's not just only listed in London. It's listed on the AIM, the Alternative Investment Exchange. So it's like the minor board, not the main board. So this isn't liquid. This is a small cap. But all their business is essentially in the US. Now, it wasn't always the case, but because US internet gambling is growing so rapidly and they're a provider of software to FanDuel, they're growing revenues over 100% year on year. So this year revenues will go from £10 million last year to £25 million this year. And I think next year they'll be £35 million minimum. So you're buying this thing at maybe 3.5, 4 times revenue next year, maybe, if they're already EBITDA profitable. They spent a lot of money in the last few years building out the infrastructure and the platform. And essentially, look, they get paid a fee based on how much people gamble, right? So they provide the back-end software. They have performance fees. They have licensing fees, but then they also get a kicker, a royalty fee, essentially based on uptake and average revenue per daily active user, right? So there should be a lot of operating leverage in a model like that. They say 6 out of every dollar, 60 cents of every incremental dollar of sales from this point forward drops straight down. That's not my working assumption, but even if you just haircut that a lot, it's very hard to see how this isn't, a 25-30% EBITDA margin business out a year or so, right? So you're looking at a company growing top line above 100% in a market that is nascent, right? Sports betting is only in 3 or 4 states, right? It's in Pennsylvania, it's in Jersey, it's in Indiana, and obviously it's in Nevada, but essentially it's only in 3 or 4 new states, and it's new states are getting added at a rate of knots, right? It's pretty hard to see how sports betting isn't legal across the whole country in a few years.
Right.
So to the extent FanDuel takes their leadership position nationwide, and to the extent this company, GAN, is able to remain plugged in, even at lower economics, which I think probably happens, to the FanDuel ecosystem, I mean, the opportunity is just massive, right? So you're paying 3.5, 4 times revenues, I think, and I think a low double-digit multiple of EBITDA, right? So I think they might do 30, 35 million of revenues next year. I think they could do close to 10, maybe, call it around 10, maybe a bit more, maybe a bit less of EBITDA. And the EV today is just over 100, it's 110 or something. So companies like that don't trade at multiples like that in the US. They just don't. The only reason this company trades at, under 4 times revenues is because it's a junior listed on the London minor exchange. So guess what? The company is doing a relisting on the NASDAQ. And they've already appointed FB Riley to lead that process. And hopefully it's a first half 2020 event. And if that happens, look, it's a £100 million company. Doesn't take a lot of eyeballs to move the needle, right? From being a £100 million company to, it could easily be to £50 million company, right?
Right.
So look, I started buying this stock when it was obviously much smaller. I've added to it recently on the pullback. It went from 80 pence to 160 pence in a straight line when they said revenues were doubling year over year. And then it came back to 120 or whatever. And now it's back at 140. So look, I think on the relisting catalyst alone, this should trade at least in line with the smallest, crappiest other SaaS names in the US, right? So don't look at the Twilios or don't look at the Zooms or whatever, but just look at the smaller, dodgier ones, which probably are worse businesses, but whatever, be conservative. Even then, you're looking at 5-6 times revenues, right? And none of those are growing 100% year over year, right? So look, I just think it's very difficult to see how this trades much below where it trades now once it relists. And I guess the added kicker is the CEO is a guy called Dermot Smurfit. He still owns, him and his family still own about 30% of the company. They took the company through a sales process due to inbound inquiries about 4 or 5 months ago, and then decided not to sell the company. In other words, they were shopping the company before the business inflected. Business really only inflected in the last, 2 quarters, let's say. So they're shopping the company on worse numbers. And even then, I think the bids were probably around 100 pence and it's 140 and the business is absolutely inflected. And the Smurfit family is one of the richest families in Ireland. They are massive in paper and packaging. So this is a tiny company relative to their wealth, but the son of the founder of that Smurfit Kappa company is dedicating all his time and energy building this company, and is fully incented, meaning he thinks this company could be a multi-bagger. Otherwise, I don't think he'd waste his time with it. So I don't mind the setup there. You have some hard catalysts in the relisting. You have a very attractive long-term story. I kind of understand why it's cheap. Essentially there's no eyeballs on it. And as I said, you have a few things in the next 6 months that should really refocus new investors' attention on the cheapness and give us a way to recatalyze the valuation to something closer to fair value. All that said, it is still a microcap. It is still a little bit outside my normal batting kind of name, and so it's sized appropriately, right? This isn't kind of an AirCap type core conviction. This is a bit more of a speculative position, but hey, you asked for interesting. I think it's interesting.
Yeah, very interesting. And what would you say is your most interesting short currently?
Okay, so the short side is far more interesting. As you probably guessed from my comments, I'm pretty worried about the market, and obviously I'm a credit guy, so look, it's not hard finding good shorts now. It's hard finding good shorts that actually work. But yeah, so the short side, there's a lot going on. So I think let's talk about NIO. So NIO is, first of all, let me lay the groundwork. So NIO is an electric vehicle manufacturer in China. They're listed on the New York Stock Exchange. That is, the ADR is listed on the New York Stock Exchange. So typical Chinese listing structure. The ADR is listed, but you actually only own a piece of paper that's an ownership interest in the Cayman Islands holding company. You don't actually own shares in the onshore operating company. So this company listed last year in the third quarter at $6.30 a share, something like that, around a $6.5 billion valuation. This company, I have to say, is the most egregious example of corporate capital misallocation I have ever seen. Right? So this company is essentially a VC project that's masquerading as a listed company. When they went public, they'd already accumulated $4 billion of losses. They'd only been around for 3+ years. They'd essentially lost $1 billion in each of the first 3 years. Look, some of that was due to the marking of the pref shares pre-IPO at a lower value, but essentially they still burnt $2.5 billion of cash in 3 years before IPO. To put that in context, Tesla, in its first 3 or 4 years of operation, it burned a couple $100 million. So essentially it burnt 10 times the amount that Tesla burnt in its first 3-4 years, which is pretty incredible. So what did they burn it on? So this company was founded by a guy called Bin Li, a Chinese internet entrepreneur who has another listed vehicle called BitAuto. The ticker is BITA. It's an it's an auto e-commerce business where they do auto loans, auto-related e-commerce platform type business. So the guy has no experience manufacturing cars. So when he decided he wanted to build an EV brand, the first thing he did is he opened his wallet, or he opened the wallet of his backers. And essentially he went around the world hiring engineers. So this company, despite the fact that it's never sold a car and never will sell a car outside of China, they have R&D research offices in Munich, in Oxford, in London, in Silicon Valley. They went on a hiring spree like you wouldn't believe. At the same time as you're hiring a lot of foreign experts, he tried to build a brand in China. And the way he tried to do it was by opening a number of, I don't want to call them stores because that's not doing them justice. They're called NIO houses, houses with a capital H. They're a combination of like a store and a health club and a library and a daycare center. These things are essentially places you'd go to hang out with your family. And also learn about NIO cars, I suppose, but essentially massive cash suck, fixed cost investments. So he opened about 20 of these things, 10 to 15 of these, more than 15 of these things around China. And he got the engineers to start developing some cars. And right now they have 2 models of car electric vehicle. One's called the ES8, which is the first model, which is a 7-seater SUV. Not really practical in China when you think about the one-child policy, but anyway. And then the second one is called the ES6, and that was released about 6 months ago. So look, we didn't really talk about my methodology for shorting too much, but it's important to know I look for three things. One is a sustainably bad business, right? So it can't just be levered. It has to be a business that just doesn't kind of make sense. So here's where NIO really checks the box, right? So if you think about a typical auto OEM, generally speaking, they have extremely high fixed costs because they got to build the factory. And, if you sell 5,000 cars, you lose a lot of money. But if you sell, 100,000 cars, you make a lot of money because, the factory's been built. You have the tooling, you have the same number of employees or roughly the same number of employees, whatever, right? So huge fixed cost, huge operating leverage. The problem with NIO is they never owned their own factory. They outsourced all the manufacturing to another OEM called GAC, JAC, which is kind of like a second or third tier OEM in China. Not only did they outsource manufacturing, they committed to cover the operating losses of that outsourced factory for the first 3 years of production for both of their first two models, right? So, if Jack builds a factory for them or builds the production line for 100,000 cars and they're only selling, say, 20,000 cars a year of a given type, they have to make it up to Jack, in terms of the differential for the first 3 years, right? So, and even if they do sell a much higher number of cars, they're paying a fixed fee per vehicle for the production, right? So if you think about it, in a very competitive market, which obviously the Chinese EV market is the world's most competitive EV market because, there's over 200 EV companies in China. And even in NIO's niche, which is the higher end luxury segment, there's probably 20, 25 competitors. If you cut prices, for example, the average price of one of their vehicles is 450,000 renminbi, but, they give incentives, whatever, they cut price, they're still paying the same fixed fee per vehicle to GAC. So you have a lot of the negatives through the fixed cost and the loss reimbursement, but you also don't have the positives. You don't really have the operating leverage, which is a huge problem when you're kind of a startup auto that really needs to scale quickly and you're burning a lot of cash from the outset, which obviously they were doing. So that kind of attracted me to the business initially because I realized the model was really not set up like a normal auto OEM, and just the cash needs of the business combined with this structural inefficiency meant that they would run into trouble pretty quickly. So that was, they listed at the back end of, third quarter last year. Then all of a sudden the warning signs kind of came thick and fast, right? So they only had one foreign board member, a Silicon Valley veteran called Pads Marie Warrior. She quit a month after the IPO, dumped all her stock. Then the company did a convertible bond deal, basically 4 months after the IPO, because they were burning 500 million cash a quarter. They raised 750 million cash. Basically, they timed it very well. The stock was very high. The strike on the convert was, $8-9 or something, maybe higher actually. I need to look it up, but they did the convert, but that was a problem because now all of a sudden they have debt at the holding company. So now we're in business, right? So on my metric, bad business, lots of debt. So all of a sudden they have $750 million of debt, which, if I have a bearish view on the stock, that's going to stay debt. It's not going to turn into stock. So then the problems started coming thick and fast. So obviously the overall auto market in China slowed down. The government cut subsidies aggressively, right? So you were getting subsidies to buy electric vehicles in China. Those were essentially cut in half in June. So volumes collapsed. Then they had a battery fire issue. So they don't actually make their own batteries. A Chinese company called CATL, C-A-T-L, a big Chinese battery company, makes their batteries. But they had a similar issue to Tesla in that the batteries started spontaneously exploding. So that kind of happened mid-year. They had to recall all the batteries. They had to recall about a quarter of their cars that they'd sold. Obviously, it was a huge reputational issue and also a huge cost issue. So sales volume started to go down pretty quickly, and that was from low levels, right? So they were selling, call it 2,000-3,000 cars a month in November, December last year, and by summer this year they were selling 1,000 cars a month. So it kind of looked like they were getting close to the wall. The reason I say that is you had these issues, that executive departures, the massive cash burn, the recall issue. Then you started seeing kind of what I call going dark from the company. So going dark is kind of a catch-all term for when a company just stops reporting financial requirements. So the company started exhibiting this interesting pattern where they would report positive news, so let's say a given month's deliveries were better than expected, they'd report it, but then they wouldn't report earnings. So the second quarter earnings...
That's interesting.
Yeah, second quarter earnings for the June quarter normally. So going back, the third or fourth quarter last year, those earnings were reported, relatively promptly. Call it 40, 45 days after the quarter. They didn't report second quarter earnings until September the 24th, right? So almost the end of the third quarter is when they reported second quarter earnings, and it's pretty clear why they didn't want to report the horrible numbers in the context of a financing raise, right? So going back to May, they had been putting out press releases saying that they were trying to raise capital from a Beijing local government affiliate called E-Town Beijing, which is essentially like a quasi-governmental entity that is designed to support investment in the Beijing area. So they put out a press release saying they're negotiating to get 10 billion yuan, which is, $1.3 billion from this entity. But then, 4 and 5 months later, they provide no update. All right, so by this stage, fast forward to, September of this year, I kind of think they're out of cash. So they have the 750 million of debt that they raised from converts. They've burned through all that. They also have, a few $100 million of Chinese bank debt. They're running negative working capital because they're essentially not paying their suppliers. And they're also building a bit of inventory on their balance sheet, but they're essentially still funding themselves through their suppliers, and they're burning $500 million of cash a quarter. So fast forward to September, and they make an announcement on September the 5th. Don't worry, we're raising $200 million of a new convert, $100 million from the founder, Mr. Lee, and $100 million from Tencent. So Tencent was a strategic backer pre-IPO. They also bought part of the first convert, the one that they issued in March, which, by the way, is now trading at 40 cents on the dollar, right? So it's gone from par to 40 cents on the dollar in 6 months. So not exactly a great sign. So they announced that they're going to raise $200 million, which, look, they're burning $400-500 a quarter, so that's not a lot, but that might buy them a month and a half, let's say. So emergency liquidity to get them to some kind of other financing solution. They announced that on September the 5th. They don't say anything on the call on September 24th on the earnings release. They specifically refuse to comment on the financing situation. They just say cryptically that there are ongoing discussions and it has not been easy to find a solution that benefits everyone. That's a direct quote from the ex-CFO. Then we don't hear anything else for another month. Then the CFO, the guy who made those comments on the call, quit. Then the number 2 finance guy, also the only other finance guy to speak on the call, quit. And fast forward to early December, and almost on a daily or otherwise daily basis, there are reports in the Chinese press that the company is either out of liquidity or potentially exploring restructuring solutions or in a cash crisis, or that lawyers have been called in to discuss potential bankruptcies. The Chinese press is essentially reporting on this with regularity, but nothing is appearing in the Western press. The only thing that's appearing in the Western press is fluffy, bullish Twitter posts from Neo's Twitter feed saying the future's bright. We just signed a deal with Mobileye, or, deliveries were great in October. Nothing about the price of those deliveries or the incentives that they're running to generate those deliveries, or even if they're paying suppliers, just deliveries were good. So we're in this weird nether zone with this company where it's very strange. There's 2 audiences, right? There's the Western audience that trades the stock, which is largely retail and frankly uninformed and not sophisticated in my view, where the market cap is still $2.5 billion. Yet the bonds trade at 30 cents on the dollar, right? So if you just run through the implied enterprise value of the company looking at the bonds, the whole thing's worth $400-500 million. But if you run through the implied enterprise value looking at the stock, the whole thing's worth $4.5 billion, literally 10 times the value of that implied by the bonds. So look, I wrote this anomaly up on my blog. It's pretty straightforward for credit guys like myself. Like normally when bonds trade at 30 cents on the dollar, the equity portion of the enterprise value should be de minimis, right? So I'll give you another example of a situation.
Has a company ever contacted you when you did a blog post about something like this?
No, I've tried to contact the company. I've contacted the company directly a number of times to ask for comment, and essentially they've gone dark. If you ask them a question about the status of their financing, They simply say no comment, please refer to our public filings, and we'll update the market when necessary.
Got it.
But that's the point. The public filings are late and or missing, right? They haven't given an update to the market on either financing transaction, either the Beijing E-Town transaction or the convert transaction. In fact, if you call Tencent and ask them, did you close your convert in investment in Neo? They say no comment, which is strange because you'd think you'd think Tencent would be supporting the company, given that they bought the last bond deal and theoretically remain shareholders. But look, I think they've closed no financing. I think if they had closed financing, they'd trumpet it to the world, right? Given that they appear to be running on fumes. So the real anomaly is in the stock because the credit market gets it. And again, that speaks to the heart of my approach, right? That you have these anomalies in smallish stocks and or corners of the market where, let's be honest, the other side of the trade is probably not that sophisticated. It's not used to looking at like credit versus equity arbitrage, or is not doing the deep dive credit work that maybe the hedge fund guys who own the bonds have done, right? Otherwise the bonds wouldn't trade at 30 cents. So look, you can set up a great trade, I think, where you buy the bonds at 30 cents and you short some delta. On some delta, you short the stock because look, if the company survives, those bonds have to be worth par, right? They have to go to par. In fact, if the company is recapitalized and more than half of the assets transfer ownership, then those bonds have to go to par immediately. In other words, there's a change of control put on the bonds, right? So if you really thought the company was going to survive, those bonds would go from 30 cents to 100 overnight, assuming they got recapitalized, right? Because given where the stock price is, it would have to be more than half the company sold at a good valuation to save the company. So obviously the market is telling you that's not going to happen. Otherwise the bonds wouldn't be at 30 cents, right? But then why is the stock market telling you the company is still worth, $4.5 billion enterprise value? That's the real anomaly. So look, it's one for the books. And the reason I say that is because it kind of hits on a lot of these angles. It hits on the credit versus equity angle. It hits on the kind of Chinese company abusing U.S. capital markets angle by going dark, not providing necessary disclosures. In fact, it hits the general nail on the head with regard to foreign private issuers. So I'm not sure if you know, but there's a whole category of companies that even though they list on the New York Stock Exchange, their ADR, they're not subject to the same disclosure requirements as a local listing, as a normal U.S. company, right? So Microsoft or whatever, or Johnson & Johnson, they list on the New York Stock Exchange. They have to file quarterly reports, quarterly cash flow statements within a certain period of time. They have to file 8K notifications anytime something material happens, whatever. For foreign private issuers, not only do they only have to file twice a year, they don't have to file 8Ks, they have to file 6Ks, but they only have to file those current reports if something deemed material in their local jurisdiction happens, right? So let's say they're a Chinese company, and let's say they get some very dilutive, terribly toxic financing from a Chinese bank. But let's say in China that getting financing from a Chinese bank is not required to be disclosed to stockholders. By the letter of the law, we don't probably have to disclose that in the US, which is kind of crazy, right? Because they're listed on the New York Stock Exchange.
Yeah.
So, it hits all these various angles. Obviously, it ties in with the whole hype around EV. And I wrote a first blog post on it back in March saying NIO is going to end in tears. That was when the stock was, $5.50 or whatever, and now it's $2.30 or something. But even at $2.30, it's a $2.5 billion market cap, right? When, as I said, the bond's telling you the equity is 9 times underwater. So, look, I still think it ends in tears. They've kind of lasted a few months longer than I thought, but I think it's a very high conviction short into the first half of 2020.
Very interesting. Man, you have a very interesting approach. This has been a great conversation.
Thanks, man.
Yeah. Was there anything else? We could wrap it up here.
I think we've gone on, I guess, longer than we probably thought we would. I would have talked about a couple of European names, which is where I see a lot of the similarities with Japan, as I mentioned, especially on the short side.
Why
don't we save that for a follow-up?
Yeah, I was going to say we could just do an episode on that at some point.
Exactly. So let's leave it here for now, and it's been a real pleasure chatting. And if you don't mind, I can maybe give the listeners some details where they can find me and follow me and stuff like that.
Please. How can people contact you?
Cool. So I guess the easiest way is to follow me on Twitter. My handle is PUPPYEH1, Puppy1. Or you can also subscribe to my blog, which is rapercapital.com, just RAPER capital.com. And look, I don't write up everything, but I try to write maybe once a month. Try to write differentiated stuff. Obviously, my approach is a little bit different. And those are the two avenues you can keep up on everything that's going on in my world.
All right. And then we'll get that all in the show notes at ericschleien.com.
That'd be great.
Yeah, perfect.
Awesome.
All right, Jeremy.
Thanks, Eric.
Yeah, thanks a lot, Jeremy. And I look forward to having you on again.
Sounds good. Speak to you soon.
All right.
Cheers.
Pleasure. Take care.
Bye.
Bye.
Thank you for listening to the Intelligent Investing Podcast with Eric Schleien. If you'd like to connect with Eric for questions, comments, feedback, ideas, or to inquire about being on the show, please contact Eric at intelligentinvesting@gmail.com. So, in the words of Charlie Munger, I have nothing to add.